Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now today I'm very happy to be joined by Fook Hien, who's a senior investment strategist at the CIO office. We obviously have a lot to talk about today. There's the renewed Middle East escalation and the resultant effect on oil prices. But we've also had some earnings from the big tech sector and next week, of course, an upcoming very packed central bank agenda. So let's jump right into the conversation. So, Fook Hien, thanks for joining us today. The past week, we've seen rising tensions once again in the Middle East, with reports now that the Houthis in Yemen have joined the conflict. How do you read the situation now, and what are the implications for financial markets, more importantly?
Yeah, hi Manpreet. The Yemen's Houthis blockade of the Red Sea following the resumption of US-Iran hostilities, it has escalated tensions in the Middle East, and that's driving a sharp rebound in energy prices and bond yields. We do expect, though, that US electoral constraints and Iranian restraint to eventually limit escalation in the conflict. We see that European gas prices are back to March peaks, but US gasoline prices remain well below the latest peaks. Notably as well, Iran has avoided attacking Saudi Arabia and UAE in the latest escalation, which is signaling some restraint. While there is a window for further near-term escalation, we think that any rebound in US gasoline prices closer to May's peaks in the run-up to November's midterm election is likely to put pressure on President Trump to resume negotiations. Thus, we expect the US crude oil or WTI to trade largely in the $70 to $90 a barrel range in the next few months, thus limiting the economic impact. And against this backdrop, we believe central banks are likely to hold rates this month as they assess any temporary spike in energy prices on the inflation outlook.
So, on that point on central banks, we saw the ECB this week already deciding to keep the policy rate on hold. But what path do you see ahead for Europe's central bank and their rate decisions?
Yeah, the ECB being an inflation targeting central bank, it is under growing pressure to hike rates in the coming months to counter any energy price driven inflation, especially if the European natural gas prices stay elevated. So we raised the probability of another 25 basis point rate hike later this year, with the timing dependent on the status of the US-Iran conflict and the pass-through of energy prices onto inflation and wage growth.
Okay, well, thanks, Fuken. So I guess rising chances that we do get one more rate hike from the ECB later this year. But what about the other central banks? Next week we have policy decisions from the Fed, the Bank of Japan, and the Bank of England.
Yeah, we expect the Fed and the Bank of Japan, BOJ, and the Bank of England, BOE, to keep policy rates unchanged. The guidance will be key. A neutral Fed should limit further gains in US government bond yields and the US dollar. And with the BOJ, or Bank of Japan, they are expected to indicate that a policy normalization will proceed faster if inflation risk intensify. And then with the BOE, it's likely to retain a cautious inflation bias. Let me go into a bit more depth. Firstly, the Fed, we see the Fed holding rates at 3.5 to 3.75%. Softer June US consumer inflation supports a hold, although a prolonged oil disruption could keep the central bank hawkish. A neutral message will cap short-term yields and reduce support for the US dollar, while renewed emphasis on inflation risk would lift yields. Now, the US dollar index, or the DXY, is likely to remain range-bound between 100.3 and 102 in our view. And then the Bank of Japan is likely to hold its policy rate at 1% next week, but the weak yen and imported inflation should preserve the possibility of further normalization. Some reports suggest that policymakers, they see scope for faster rate hikes if the yen weakens. And then if there's a higher fuel cost and quicker cost pass-through push inflation above projections. So, combined with our expectation that the Fed will remain on hold, this should eventually allow the dollar yen to ease. Technically, we believe the dollar yen correction is likely to be gradual rather than immediate. So, potential intervention and higher pension fund allocations to domestic assets may slow the Japanese yen's depreciation, but a sustained reversal will require a narrower US Japan interest rate differential. So a sustained break below 160 will bring the 155 to 158 range into focus. And then lastly, on the Bank of England, the rate decision is due on the 30th of July, following June's 7-2 vote to keep rates on hold at 3.75%, with two members favoring a hike there. We expect another hold next week. Concerns about persistent energy-driven inflation is likely to lift the UK gilt yields and support the pound, although a weak activity and fiscal uncertainty may limit the gains. So the pound to the US dollar is likely to stay range-bound in our view between 1.32 and 1.35.
Okay. Thanks very much for that detail. Maybe just moving on from central banks, the other big event we expect next week is more US big tech earnings. What are you expecting from that next week?
Yeah, we expect the US big tech companies to deliver solid Q2 earnings while demonstrating further evidence of AI monetization. We are overweight the US technology and communication services sectors. The US technology sector, it continues to be a primary driver of the S&P 500 earnings. They have the highest projected earnings growth over the next 12 months. And it is expected to see earnings growth of 65.6% year on year in Q2 and 57% for the full year 2026, largely driven by AI demand. Besides a strong earnings growth, we expect the US big tech companies to demonstrate that elevated AI capex is translating into stronger monetization. We see the US Census Bureau data indicates that AI adoption has already reached 20 to 25% across US industries. This rapid uptake it signals strong enterprise acceptance, and it gives us greater confidence that AI usage remains in the early stages of a multi-year growth cycle. Now, the emergence of cost-effective and high-performing Chinese AI models that has raised some concerns about AI commoditization, which can reduce the returns on AI capex. However, we believe that as AI resources become more efficient to use, total consumption will rise, which is commonly known as Javon's paradox. So, to gain exposure, we are overweight the US technology and communication services sectors, with the latter being dominated by your large internet platforms.
All right, and finally, what about the earnings outlook from Japan and Europe's financial sectors? I think we've got some interesting developments there as well.
Yeah, we expect a constructive earnings season for Japan and Europe ex UK banks, and we remain overweight on both sectors. The earnings backdrop for Japan banks is supported by the Bank of Japan's two 25 basis points rate hikes in December last year and also in June this year. And these are feeding through via lagged loan repricing and expanding domestic net interest margins. Notably, the regulatory easing of Japan Bank's exposure limits for individual corporate groups will grant the mega banks greater flexibility to underwrite large-scale M&A and AI data center transactions. While the near-term earnings benefit of this policy is incremental, the medium-term implications are more meaningful with greater flexibility to support loan growth. And then Europe banks, they're also entering the Q2 earnings season with a constructive set of catalysts. Net interest income there is benefiting from a higher for longer rate path, and fee income is supported by resilient investment banking activity and a stabilizing wealth management segment. Meanwhile, credit quality remains robust with the European banking authorities' June 2026 risk assessment showing that non-performing loan ratios are sitting at historic lows. Sustained capital distributions via dividends and share buybacks, they continue to be a key catalyst and represent a compelling risk-adjusted return opportunity.
All right. Well, I think that we're out of time for today's conversation, but thank you, Fook Hien, for discussing that with our listeners. If I can take our top sort of takeaways from today's conversation. First is a central bank heavy week, but we do expect the Fed in particular to stay on hold, which would leave the US dollar range bound. Second is some positive outcomes from Europe and Japan's financial sectors, with earnings, of course, remaining supportive. And third, in the US, we're still overweight the US tech and communication services sectors, but we'll be watching the details of the signals on AI monetization in particular as we go through the earnings season next week. So thanks very much for joining today's podcast. We hope you enjoyed the conversation, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.